start. We don't quite have a quorum yet, but hopefully we will by the time we get to tab 4. Oh, Trish is just joining now.
Sorry.
Okay, we do have our quorum now. You're on mute, Mike.
Hi, Trish. Okay, I'd like to call the audit committee meeting to order, and I would ask Ellen to take the roll call for the meeting.
Good afternoon, everybody. I'll just say again that we are having internet issues. Hopefully it will get resolved. I know David Demers is working in the background, working diligently to resolve the problem. And we'll keep you updated through the chat if we're going to have additional issues, but hopefully we'll be able to have this meeting without any problems. Trustee Bartholomew.
Yes.
Trustee Donnelly and Trustee Ames will not be able to join us today. Trustee McMahon.
Present.
Trustee Martin.
Yes.
Trustee Mishu.
Present.
Trustee Riley. Oops.
Here.
We do have a quorum, and we also have Trustee Kane joining as a non-committee member.
I might just be on for a little bit, but wanted to listen in, and I'll hop on and off as I need to. Thanks.
Okay, great. Well, thank you. And I'd like to remind participants to please leave your mic muted when you're not speaking. The first item agenda under tab 1 is a University of Maine Department of Athletics Agreement upon Procedures report, and Samantha is going to give that to us. Samantha?
Good afternoon, everyone. Thank you for the time. I just wanted to report upon our July audit that we do every year. So we had the auditors were here from July 11th to the 15th of 2022, and they looked at a few different areas of testing with transfer eligibility certification, our investigation and self-reporting of rules violations, extra benefits with complimentary admissions, playing and practice seasons, and how we monitor head coach responsibility. So I will say, out of all the areas they've tested and the dozens of samples we've given them, we've had only 4 findings and 4 recommendations, which is good news for an athletic department in that area. A lot of the findings are are smaller incidental findings, a lot of them around just paperwork, student athletes forgetting to check a box, or an athletic trainer not double checking a date on a physical. So I will say that this year we have scaled back a lot of our beginning of the year forms, because that's where a big bulk of the findings were. I think student athletes had to do kind of like 15 to 20 forms, and we've scaled it back to where it's only about 8 now, the main core ones that we need. Additionally, we added an additional compliance person in our office. This person will mainly be tasked with kind of those beginning of the year forms and checking boxes and making sure student athletes complete them. Some of the challenge comes in is that we have to wait for the NCAA to send us the forms, and they don't do it on a regular timely basis in July. So we're kind of scrambling to get them done before practice starts in the beginning of the year. Additionally, I've worked with the other areas with sports medicine and our ticketing office to look at their kind of best practices to see what they're doing and work with them to, kind of implement some new things that will make it both efficient for them and efficient for us. Additionally, as much of how stressful the audit is every year, it's a great checks and balances for us. And it allows us to kind of really reflect on what policies and procedures and kind of things we're implementing here at the university, and being able to kind of shore up our day-to-day operations. The auditors really do poke holes in everything for us. So it's really great to kind of have that check, and also allow us to brainstorm and sort of streamline some things that we potentially might not be, to make it more effective. So, and with that, I'll open it up to any questions or concerns anyone has.
Thank you, Samantha. Are there any questions from anyone? Oh, I guess not. You did a great job, Samantha. Thank you very much as well for all the hard work that you guys are doing. So appreciate it.
Of course. Thank you very, very much for your time and being able to present our wonderful athletic department to this group.
Great. Thank you. Well, then we'll go to tab 2, the audit committee work plan. Tracy, you're up.
Thank you, Trustee Ishio. I just wanted to point out a couple of things on the audit work plan. It's a very routine plan. We meet twice a year. And as you just heard, NCAA is reporting as a routine part of that. The fall, we have compliance information as required for Division I schools. And we also have a financial presentation in the spring from athletics. Today, you'll also hear from our Director of Accounting on the annual financial report. I just want to take this opportunity to thank her for all the work that goes into that, as well as the staff. And we will hear from our auditors, Clifton, Larson, Allen, often presenting various updates about the audit or accounting standards and everything's of relevance there. And in the spring, we meet again to discuss the single audit report required under uniform guidance for federal funds. And we hear again from the auditors about that report, as well as the planning for the upcoming fiscal year. The only change in this work plan that will go to the board in November is that we did drop the COVID update off as a routine item, but of course that is an item we can always discuss at your pleasure. And Gretchen Catlin also presents to the committee on a routine basis about risk management, and we expect that in the spring. Happy to take any questions.
Great. Thank you, Tracy. And she's absolutely right. The only change from previous work plans is the COVID. Are there any questions? No, don't see any. So great job. Thank you very much, Tracy. Appreciate it. So moving on to tab 3. You're up again, Tracy, on the post-employment benefits plan.
Thank you. And today we have with us Linda Bourneville with KMS Actuaries. And she actually does 3 actuarial reports for us, the incentive retirement plan for faculty and professional staff, as well as the closed defined benefit plan for classified staff. And this more material one is the other post-employment benefits plan, which relates to retiree health for eligible participants. And as you may recall, last year we added an additional option to our Aetna group plan for retirees, and it was the Medicare exchange with a light. We had about 41 of our participants join the exchange program as compared to the 59% for the group health plan, and only in the second year, but we had a very favorable result in last year's actuarial report, and the impact of the financials with the market condition and other factors, it did swing the other way. You'll hear more about that from Linda today, but I'd welcome her to join us and present the information she has. Thank you.
Thank you, Tracy. Linda?
Good afternoon. And Darla? There we go. Hold on. Okay, there we go. So good afternoon, everybody, and thank you very much for having me. I think this is year 2 that we present to the audit committee on the results of our annual evaluation of the post-employment benefits other than pensions, and the acronym there is OPEB. If you ever hear the word OPEB, what it really just means is other, really the O is other than pensions, so not a pension plan, but generally OPEB encompasses health insurance benefits, dental if it were offered to retirees, life insurance, that kind of thing that is just not pensions. Darla? So just a quick overview of what my discussion will kind of wrap around today. What is this valuation? What is it that we do exactly? And what do we do with the results that come out of this actuarial valuation? Actuaries prepare models of future expected events, and this is one of those. The University of Maine system has established an irrevocable OPEB trust that we'll talk a little bit about. Obviously, every year we have key results that are the outcome of this model. And then we'll kind of let you know, like, what do we do with these results? Where do they land and what do they mean? Darla, sorry. So every other year, we actually prepare what's called a full actuarial valuation. And what that means, a full, is that the university system provides us with census data for every single retiree who is in this program, as well as any active employee who would potentially be eligible for this program. So that's the every other year kind of valuation. We run liabilities, we compare those to the assets at the measurement date. What 2022 was not a full valuation. It was what's called as roll forward. We don't collect all the data. Demographics tend to not change as much, or it's not as volatile a number as your assets at the measurement date. So the GASB and accountants and the auditors all allow us to do what's called a roll forward. We literally take our calculator and we roll the numbers forward using typical techniques of, adding interest to the number and rolling it forward. So this year was a roll forward. We did not have to bother Carla and Darla for all the census information. We literally just rolled it forward. But there's a lot of other information we still collect to prepare these results. As part of our actuarial standards of practice, we want to review all the assumptions that we use, even though it's a roll forward. We want to make sure they're still appropriate, that they're consistently together, they're reasonable and all that, and more on that later on. When we develop the results from this actuarial evaluation, we do something with these liabilities. We can develop funding contributions. What would we put into that OPEB trust? And we also develop financial statement disclosures. There are two standards that drive the OPEB disclosures, GASB 74, GASB 75. They came into effect back in 2017 and 2018. These are material items on the financial statements. It is a large number, these OPEB liabilities. Effective in 2021, last year, we did implement, as Tracy mentioned, the new HRA exchange program. And then most importantly, we are recognizing the asset value as of the measurement date. No such thing as a roll forward with assets. You actually look at what truly is set aside in the bank. Darla, thank you. So the actuarial evaluation model is really just we're going to gather some information. We kind of like throw it all in the blender and out pop some actuarial results. And already mentioned, UMS submits employee and retiree data to us. We look at that data. We might have questions on it. We kind of vet it out, making sure it makes sense, especially compared to a measure we might have done 2 years ago. UMS will also provide us with this thing called the substantive plan. What do your retirees understand this benefit to be? And that could be in the form of communications that you've sent them, letters, memos, documents, anything that provides to us what exactly is it that you're providing to your, what the promise. Basically, it's the promise made to your employees once they retire. So those plan provisions are important for us to understand. I previously mentioned we're going to look at actuarial assumptions, things like what is the probability somebody actually will make it to retirement? There's other things that could happen, right? They could die, they could just terminate and leave, or they would retire. And once they retire and they elect this coverage, how long are they going to live? So there's a very long-term model that's put in here. We project things out for about 100 years. And then we take all that information, all those expected future payments, and we discount them to the present. Those results are used then to calculate things like a funding contribution and accounting disclosures. And as I already mentioned, 2022 was a roll forward year. So basically the first bullet here in this slide, that did not happen this year. Darla? The member data, again, we collect all information on active employees who are potentially eligible for OPEB. And here's a list of the key data things we're looking for. Because those assumptions, right? Women live longer than men. We need to know their gender. We need to know how old they are because we need to figure out how long we think they're going to live or when they're going to retire and that kind of thing. the retirees and spouses who are currently covered under the OPEB program. And what program are they covered under? The exchange or the Medicare Advantage plan? So we need to know where everybody kind of is so we can project what we expect going forward. Darla? So the plan provisions, as I mentioned, won't go through every item in this slide. It's all disclosed in our actual valuation report. There's probably about 3 pages of plan provisions on exactly how we understand the, what is provided. And that has been vetted and updated a lot over, many, many years. And then obviously effective January of 2021, we added a pretty significant change to those plan provisions, and that was with the retiree health exchange. So the assumptions, there are many, many, many assumptions that are used in the projection of these benefits. Some are obviously much more important than others. The discount rate is the single most important assumption that we need to develop. And we do this along with the investment consultants that actually work with UMS to develop the funding strategy. What does our portfolio look like? What do we want our targets to be in certain classes of assets? And then the investment consultants will have their expectations, their capital market expectations going out 30, 40, 50 years maybe, on what does each class look like? What do we think it will return? And then they blend it all together based on your targets. And they, they usually kind of give a range on what's acceptable. And then we review all of that and kind of make sure that we agree with their market expectations. And FYI, we do. And so right now, and no change from the prior year, our long-term expected return on assets is 7.25%. There is an inflation assumption built into that. That could fluctuate. Obviously, it is, buzzword in the news lately. But again, considering we know we're coming off, a 1-year inflation numbers in the 8s and maybe 9%. This is a long-term outlook. We don't want to be too reactionary on how we think inflation is going to change, because this is really over a very long-term horizon that we're looking at. The next most important assumption would be your healthcare trend rates. How do we think healthcare is going to increase in cost over time? Inflation is a big part of that. We're going to say the model or the idea, it's still out there. We don't know exactly what did COVID do to healthcare trend rates. What did COVID do even to our mortality and mortality improvement rates? We don't know that yet. We don't know how things are going to get adjusted for that. But again, we're looking at a long-term model. We don't want to be too reactionary and changing things. So these are things that we're continually watching and continually, updating if required. A few other demographic assumptions, as I already mentioned, mortality rates, very important assumption, right? How long are people going to live completely impacts the cost of this program. How long will the university be funding or paying for some or all of retirees' healthcare in the future? The OPEB trust. So the university system has decided to introduce an OPEB trust. Not every public system, every public anything, all have trusts. It's a choice of the participating employer. But there are many benefits to having a trust, and I would say one of the key benefits is that you get to use that long-term rate of return to discount your expected benefit payments. Why is that important? Higher discount rates create lower liabilities. That liability is on your balance sheet. Okay, so if you didn't have a trust, you'd be looking at discounting at a high quality municipal bond rate. Think about it this way. You've made a promise, you haven't funded it, you haven't set anything aside for it. It's basically like a loan. You have an outstanding loan. So it's this municipal bond rate that you would have to use. This, because you do have a trust, and we think today at this valuation that you will, quote, never run out of money down into the future based on this group we've got together and the plan you've got right now. You won't run out of money. So we get to say, all of these future expected benefit payments will be funded through the trust. So that's good news that you're able to use that long-term rate of return. What's the purpose of the trust? You want to accumulate your assets to pre-fund these OPEB liabilities. And at some point, which you had started already, you would actually be using the trust to pay the benefits, right? So you can put some contributions in, but you want to be able to use that trust and its investment return to pay benefits. GASB requires 3 criteria in order to recognize a trust on your financial statements, and those are listed here. So I mentioned a funding policy. Not only does not everyone have a trust, many don't even have a funding policy. They might say, oh, we've got some extra money hanging around. Let's fund this year for OPEB, next year we won't, kind of willy-nilly or very ad hoc. UMS does and has developed a systematic method of pre-funding to their OPEB trust. It has been in place since 2008. And that is a time when the GASB actually introduced the original first OPEB standard, and that was GASB 45 and GASB 43. So with that kind of awareness of this promise made, many entities said, oops, now we've got to start measuring this liability. Let's calculate that number, and oh dear, it's a big number. Maybe we need to start setting aside assets for it. And that's when the system actually started pre-funding to the OPEB trust. In 2017, a formal funding policy was actually drafted and adopted. And then we look at that, or you guys look at it, we assist in looking at that policy annually to make sure that it's still in line with exactly, what are our goals and what is it we're trying to do. We also want to be able to look at the results of the most recent valuation and see that they are still kind of in line with our policy, or it's really vice versa. Is our policy still in line with what kind of results we're getting? Already mentioned the benefits to funding. You're going to use that trust to pay the benefits, and you get to use a higher discount rate. And most recently, that funding policy was adopted actually just this month. So key results, a lot of numbers here. Probably won't want to describe every one of them, but this is what we do. We kind of look at the assets from the beginning of the year. We bring them forward to the end of the year. This is reality. This is what truly happened in FY 2022. We started with about $180 million, ended with $156 million. Most of that decline was an actual loss, an actual return that was negative. We look at things not always in terms of the actual return, but what was the gain or the loss during the year? Meaning, what did we expect? And then what did we get, right? So we expected 7.25% on our assets. Remember that long-term rate of return I talked about? So we expected a $13 million return on assets, but unfortunately, with the markets as they were at June 30, 2022, the actual return was a minus 23 million almost. So that created a $35.7 million loss on investments. That loss, as you can see, very volatile numbers going on here. We do under the GASB standard get to kind of defer some of that loss over time so that expense may not be as volatile as, it would be otherwise. But that still is a pretty volatile number. Going to the right-hand column, this is the liability. This is the number. This is the benefits we're expecting to pay. Beginning of the year, we're looking at about $162 million liability that will need to be funded, but that does roll forward to the end of the year with mostly interest, 174 million. All those benefits discounted at 7.25. So the comparative number you're looking at is your total liability, 174 million, and then your assets, 156 million. So we're looking at about a $17.8 million net OPEB obligation. Another way of saying that, net OPEB liability. That's kind of where we are not funded, if you want to call it that. Just a little graph on where we've been. Again, I mentioned the GASB standard for this GASB standard 74 and 75. That's been around since 1718. The darker green bars are your liabilities. How are those changing over time? A lot of stuff going on here. Maybe discount rate changes. different programs put into place, healthcare gains and losses all over. And then you'll see a pretty significant drop in 2021. That's that exchange program that was implemented that actually reduced the liability by about $50 million. Roll forwards generally create increased liability, so you'll see that. But as you see, the hugely volatile component of this measure is the asset value. We were fully funded, or quote, some people would say in a surplus in 2021. And it's all snapshot kind of thing on that day. I always tell people you are either fully funded or not, or 111% funded on one day. The next day, the market could change and it's a different story. And so a year later, it was a pretty significant different story. So now the system, June 30, 2022, is 90% funded. So what do we do with that? Well, a big component of our evaluation is that you take the results of these and you create disclosures and expense and asset or liability information for your financial statements. As I mentioned at the onset, this is a pretty big piece of the balance sheet when you were not funded. If you weren't funded, we'd be looking at about $175 million unfunded, but you do have all those assets set aside. That creates a much smaller liability, $17.8 million as of June 30, 2022. There's also an expense component that is developed. It's pretty much just the change year over year in the net liability, but there are some things that are a little bit different. Benefit changes are recognized immediately. It is left. A benefit change is pretty much under the full control of the plan sponsor. So they say, you know, you can control this, but you have to recognize this change immediately. Other things don't have as much, you know, you're not going to have a whole lot of say over whether people live or die, I hope. You know, so there's some things you just don't have control of. You get to defer some of those changes. And these three are the three that are recognized. I mentioned already investment gains and losses, you get to recognize over 5 years. The other two, it's over the expected future service of your employees. And that right now is about almost 7 years. Resources, basically one thing, or the GASB, if this is all very exciting to you and you want to learn more, the GASB has a website that you can, you know, check the standards. The accountants are, you know, your outside auditors, CLA, we would work with them to make sure they understand everything we're presenting. But our report, you know, is about 50 pages, I believe, of disclosures and memorializing all the assumptions that we use and the methods that we take to prepare all this information. Be happy to take any questions that anybody might have.
Thank you very much, Linda. I have just a quick question. When you look at the actuarial assumptions, how often do you change those? And if you start off with this as the assumption, but all of a sudden, say 2 months later down the road, something changes dramatically, how often do you change those assumptions?
That's a great question. So there are, as I already mentioned, a few different assumptions. One of the most popular that we will change and look at probably most frequently will be the discount rate, because the economic environment has changed, and along with that, the inflation rate. So those are the two that get, I would say, the most scrutiny and the most serious scrutiny every single year. Even if we're doing a roll forward, if NEPC, the investment consultant for the system, says, you know, our outlook is now dropping, let's call it a year ago, that's the trend. The trend was pushing that long-term rate of return down, down, down. What we're seeing now over the last 6 months are capital market expectations that are increasing by like 100 basis points. Not to say we're going to 8.25, you know, actuaries are sweating it out that we're hovering around 7, and we like that. So we probably wouldn't want to go up that much, but you know, again, we have to make sure that the investment consultants who have different long-term perspectives than actuaries do, that, you know, we want to make sure that we're kind of on the same page. The other assumptions, we're not going to change those a whole lot. Those don't really impact systems as much as that discount rate, or, oh, sorry, the other one that we do look at every single year is the trend rates. how do we think medical? Because those surveys and studies are done on those practically monthly, like you were just saying. But we would really just change those assumptions once a year at the measurement period if we feel they're warranted to be changed. The next assumption we're going to look at and we're going to keep up with, the Society of Actuaries does prepare mortality studies every year. They actually just came out yesterday with their latest mortality improvement for 2022. They are deciding to not issue a new table. Why? The 2022 study incorporates 2020 mortality. That is off the charts. It would really skew our future expectations for mortality because the questions that still remain are the people who died of COVID, that they're going to be already reflected in the experience that we get. Is that really going to change our expectations for the future mortality of the remaining people in the system? We don't know that. They don't want to include a year of 2020 where there were absolutely excess deaths, right, over the national average of how many people die every year. So that's out. So that's going to be something like next year, we probably, is there going to be a 2023 table? I don't know. So we'll, we watch that one. The other assumptions, when do people retire? We actually look at a gain loss every year and we can identify the causes of some gains and some losses. And if you look in our report, the demographic experience gains and losses tend to be pretty small. We're not going to see a $35 million loss like we do on investments. So that's kind of a, longer answer than I thought I would say at first, but on assumption changes.
Well, good, great. Thanks a lot, Linda. Trustee McMahon.
One of your slides, Linda, talked about a revised funding policy adopted October 7, 2022. Can somebody give us a high-level overview of what the funding policy revision was?
I can do that, and Linda, you can fill in if you would please. But we changed the funding policy because last year we were 111% funded. So we were in a position that we could begin to pull monies out of the trust to pay some of our expenses. Part of our process is to pay as we go. So when we get those bills, we pay them. So we, in essence, consider that a contribution to the trust. But being overfunded, we would have to pay less of that or pull some monies out. We then became underfunded again this year. So we didn't want to be pulling money out. The other challenge is it's very difficult with a new plan that we've adopted to project what the expense is for the current year. And we pulled some money out on April 1 based on projections that we didn't end up needing. So we had to recontribute it in October. So now we're just going to look after the close of the fiscal year when all the numbers are known. We're going to true up for the first day of the quarter in the new fiscal year. So really just two things to stop the volatility and to have a better measurement point when we contribute those final true up dollars, but also to recognize we're going to use a method that, and Linda does it every year. She does an actuarial determined contribution, and that recognized the fact that we had fallen under 100% again.
Thank you, Tracy. Any other questions? Yeah. Chair Raleigh.
I was struck that when you show very clearly when we implemented the exchange, we saw the savings and the impact, and it moved to 111%. The very next year, it pops back up. What were our expectations for savings over time? And this may be for Ryan. With the move to the exchange, are we meeting our expectations?
Could I just comment a couple of things on that? That there was a one-time hit in the year of implementation because actuarial requirements are that you would recognize a savings in the year of plan change. So that, what was it, like $49 million was a one-time hit benefit. And so we wouldn't expect to repeat that, but what we would expect to have been able to do if we'd have maintained that overfunding status was to minimize cash flow going into the trust or going out towards benefits, because we had less of an expense and a less of a cash contribution need because we were in a well-funded position for two reasons. Last year, we had a $37 million return for the OPEB assets that are invested in the managed investment pool. And then we had that $49 million one-time experience. And so we didn't have that same experience this year. And we had a loss of $22 million, so 27 million. 23.
Great.
If I could just add one thing to that, that $49 million quote savings, that is the present value of all the future years of savings. So year by year, there'll be, as Tracy said, some cash savings, right? That the benefit you expected under the old program isn't being paid anymore, but a lower benefit may be paid under the new program. So year by year, there'll be some cash. And an actuary hopes that the present value 50 million is exactly all the savings that you will have. But of course it won't, because things just, I can tell you with 100% guarantee, all assumptions are never actually met.
Thank you, Linda. Are there any other questions? If not, I'd like to once again thank Linda and Tracy for the presentation. Appreciate it. Now, moving on to tab 4, the annual financial report, which will be given by Darla.
Good afternoon, everyone, and bear with me just a moment as I share my screen. Never quite sure which one's going to pop up. So I guess at this point, are you seeing yourselves as well as the presentation, or just the presentation?
We're seeing the presentation and you, Darla, which is perfect.
Okay, great. Thank you. So this afternoon, I'm pleased to present to you the university's annual financial report for the year ended June 30th, 2022. And as the chair mentioned, this is located at tab 4.1 of your materials. This 117-page report is in draft form, awaiting board approval later this afternoon. Rather than speak from a report that's 117 pages long, I will instead speak from the PowerPoint presentation, which is in tab 4.2 and is actually what you're seeing on the screen. And before we get started, I'd like to extend my appreciation to our auditors, Clifton, Larson, Allen, and to all of the campus and system personnel who responded to our requests for data during the audit. There's a lot of time and energy by a lot of people that go into completing the audit and producing these financial statements. And sometimes these requests come at otherwise very busy times. So I thank everyone for making the audit a priority. And I also want to thank my staff for all their efforts in getting us to this point. And in particular, I'd like to thank Janice Elsmore, Assistant Director of Accounting. She heads the audit each year and prepares the bulk of that 117-page report. And this year, she was actually also the lead on for the team that implemented the new accounting standard on leases. And I get my clicker to work. So here we see the discussion topics for today. Many of these I'm just going to touch on ever so briefly so that we can spend most of our time in pages 6 through 10, which address the financial activity for the system for FY22, as well as its net position as of June 30. Now, if you looked at the table of contents in the actual annual report, you'd see that the report is quite comprehensive and has several sections to it. Today, I'll be addressing 2 of those sections, the auditor's opinion and select financial statements. And starting here on page 3, you see that we have 3 sets of financial statements, and the auditors actually provide an opinion on each one of these sets. The first one in the first column, the first set addresses system-wide financial statements, which cover the system's assets, liabilities, deferred inflows and outflows, net position, revenues, expenses, and cash flows. The middle column contains statements related to the system's discretely presented component unit, which is the University of Maine Foundation. And finally, in the third column are the statements that cover the universities. Whoop. Did someone have a question? No, okay. So the third column addresses or covers the university's fiduciary activities. As you may recall, these statements were new last year, so this is just the second year that we're producing these. And they cover the change in monies that the university system holds on behalf of external parties, such as the OPEB trust that Linda mentioned, is invested in the managed investment pool run by the university system. And there are several other external parties also invested. And it also covers student activity fees that we hold on behalf of the various student groups. Before we jump into the financial statements, I just want to touch briefly upon the independent auditor's report and point out that this draft opinion is an unmodified opinion, or what we call a clean opinion, the type of opinion you want anytime that you're audited. And if you were to read through the language in the opinion, you notice that the discretely presented component unit, again, the University of Maine Foundation, their most recent data in the financial statements actually only covers a 6-month period. The 6 months ended December 31st, 2021. As you recall, last year, there was some difficulty in getting their audit wrapped up in time to complete the university system's audit. So foundation management made the decision last year to change their fiscal year end from June 30 to December 31. And that better enables them to get their audit wrapped up and meet deadlines that the university system has. Looking briefly here at page 5, I mentioned a moment ago that there was a new accounting standard that was implemented during this fiscal year, and that was the new standard on leases. And because we produce comparative financial statements, we had to go back and restate FY 2021 for the impact of this implementation. And so here we see the statement of net position with a column for, as originally stated, and then as restated. And with that new accounting standard, the system's now required to include all of its leases in its balance sheet or statement of net position. And previously, only those leases that met criteria for capitalization were included in this statement, and all other leases, which you may have heard referred to as operating leases, ran through the P&L or statement of revenues, expenses, and changes in that position. But now they're all in this statement. As a lessor under the new accounting standard, so one of those leases that got discussed during the FFT meeting this morning, for that type of lease, the system records a lease receivable and a deferred inflow of resources. Now, as a lessee, where we're leasing property or assets from someone else, we record a right of use asset, which is part of this capital asset line, and we record a lease liability. And each lease payment, whether we are receiving them or making a lease payment now contain an interest component, and that interest component flows through the statement of revenues and expenses as either interest income or interest expense, and also flowing through that statement of revenues and expenses is amortization of this deferred inflows, and that amortization is recognized as rental income. And we also, going through that statement, would be depreciation of the right of use assets that are included here. So we depreciate those similar to what we do with assets that we actually purchase outright. And we see that the net impact on restating FY21 is a reduction in net position, more specifically the net investment in capital assets category of just under $1.2 million. So not an extreme impact by any means. So turning to page 6, I'll first discuss the statements of revenues, expenses, and changes in net position, what we refer to, because it's a mouthful, we just simply call it the SHRECnet. And as required by accounting standards, we presented the system's revenues and expenses in 4 categories. The operating revenues and operating expenses that you see here on this slide, and also non-operating revenues, expenses, and other changes in that position, which you'll see on an upcoming slide. Now, looking at the FY22 column on this page, we see operating revenues of just under $467 million, less operating expenses of $811 million, for a resulting operating loss of $344 million. And I'll note here that the system's operating expenses are always going to exceed operating revenues, as GASB, that's the Governmental Accounting Standards Board, they require that certain revenues that the system relies on to fund operations, they require that those revenues be recognized as non-operating, and we'll see those in a moment over on page 8. Moving back up the page and taking a moment to look at total operating revenues, there's actually good news in this line. This $467 million total, as you can see, increased $61 million from the prior year. And this is actually the first time that this line has increased since the pandemic began. In the prior 2 fiscal years, in FY20 and 21, there were a couple of revenue lines such as gross tuition and fees and recovery of indirect costs that increased each of those years. However, in this fiscal year, as you can see, all but one of the lines under operating revenues increased. The only one that still declined was other auxiliary enterprises. And I'll just note a couple of the increases. First, gross residence and dining fees increased 63%, and educational sales and services and other revenues increased 58%. These 2 lines had been significantly impacted by the pandemic in both FY20 and 21. So thus seeing increases this year is definitely good news. Unfortunately, or I'll caution, although those 2 lines plus the total increase this year, all 3 lines are still below what I would call pre-pandemic or FY19 levels. So headed in the right direction, but definitely haven't recovered what we probably would have had if not for the pandemic. So now looking at operating expenses, we see that they increased $131 million or 19% from the prior year, definitely outpacing the growth in operating revenues. Now, there are 3 immediately measurable items that contributed to this increase. First was a $50 million increase in costs associated with the OPEB plan that Linda just discussed. During that conversation, we mentioned that in the prior year, in FY21, there had been $49 million of savings due to the plan change, versus this year, there was actually no OPEB expense of $3 million. So a large swing, and that's accounting for this 452% increase in institutional support. The OPEB costs flow through that line on the under operating expenses. Another item impacting the increase in operating expenses is an $18 million increase in coronavirus relief monies awarded to students. We had additional funding available to us this year, and that $18 million is the cause of this $17.5 million increase in the student aid line. And finally, the $10 million, there was a $10 million cost of a special retirement incentive offered to faculty members during FY22. And that $10 million is captured in this $14 million increase in instruction. And the remaining $53 million, or 8% increase in total operating expenses, is attributable to a variety of items such as compensation increases, inflation, increase in grants and contracts activity, just to name a few items. So now, still on page 6, but moving to the bottom, we again see that operating loss for both fiscal years. And if you looked back historically through the university's annual reports, you'd see that every year there is an operating loss. So moving briefly to page 7, we again see total operating expenses, but this time on what we call a natural classification. And the change in the OPEB costs and that incentive plan that was offered to faculty that I mentioned a moment ago, those are the drivers in the $61 million increase in benefits. And student aid on a natural classification basis is the same as it is on a functional basis. So those extra coronavirus funds are still the driving force in this $17.5 million increase. Now moving to page 8, we'll look now at what's the bottom half of the shortcut. And we start again with that operating loss that I just mentioned. And then the next category is non-operating revenues expenses. And we see the various revenues that I mentioned that the system relies on to fund their operations. You know, key things like state of Maine appropriations, gifts, endowment return used for operations. And if you were to add all of those, well, if you add them all up, yes, they are $334 million for FY22. And you offset the operating loss with those, you see that the system actually ended FY22 with a loss before other changes in net position of just under $10 million in comparison with the $58 million of income from the prior year. Now at $334 million, net non-operating revenues, as you can see, are relatively flat compared with the prior year. However, there are 3 lines within that total that I want to note because of the significant variances from the prior year. First is the non-capital state appropriations line, which increased 5%. This increase was certainly good news for FY22 after having experienced a curtailment in FY21. The next line I want to note is the coronavirus relief funding of $63 million. As you can see, that was up significantly too, and that's primarily is because we had that third round of funding from the federal government that came in towards the end of FY21. So both years for this coronavirus relief funding line contained federal funds that the system received directly from the Department of Education, and we refer to those as HERF monies. It's the acronym for the actual name of the law that was passed. And also federal funds that flowed through the state of Maine for testing and personal protective equipment. Since the beginning of the pandemic, just as a quick review, the system was awarded 3 rounds of federal HERF dollars that totaled just under $104 million. And the system has recognized a portion of those awards as revenue in each of the years FY20 through FY22. Each round involved awards specifically for student emergency aid, as well as awards for institutional needs. As was the case in FY20 and 21, revenue recognition in FY22 for the HERF institutional awards was limited based upon what percentage of the student awards had been spent. So there's this ratio that the government or the federal regulations require that, you know, you only get to spend X dollars of the institutional amounts if you spend X dollars of the student award. And GASB, as far as revenue recognition, requires that you keep the stick with those ratios. So as you may recall from last year, the system had applied $17 million of lost FY21 revenues against the HERF 3 institutional awards. However, the system couldn't recognize that $17 million as revenue until this year when they spent the HERF 3 student awards. Again, keeping maintaining that ratio. And as of June 30th, 2022, the system has $4 million of HERF awards remaining to recognize as revenue in FY23 as the outstanding awards are spent. Now, the final line I want to note in this section is the investment loss of nearly $14 million, which represents a $36 million decrease from the prior year's investment income. And as we've come to know all too well this year, investment income can fluctuate significantly from year to year, depending on investment markets. I looked back at my notes from last year's meeting, and at that time, I had been telling you that the positive return that we experienced in FY21 was $10 million more than the second highest return, excuse me, experienced in the previous 5 years. And this year, we're discussing an investment loss, which is the first experienced by the system since FY15. And at that time, the loss was only $1 million. Excuse me. Remaining here on page 8, we'll now move to the section on other changes in net position, which totaled $36 million for FY22, and that's down from the prior year. And revenues in this section differ from the others on the SHRECnet because revenues in this section support additions to capital assets and endowments, or the reduction of debt items that are found on the statement of net position rather than within the SHRECnet. And I'll remark on just 3 items in this section. First is state of Maine capital appropriations, which increased 59% from the prior year. These revenues are recognized as expenses are incurred. So you spend $1, you recognize $1 of revenue. And the amount of the revenue can fluctuate a lot from year to year, depending on the timing of the related construction costs. This line is comprised of a couple of things. First, proceeds from general obligation bonds that the state of Maine issues and repays, as well as annual appropriation that the state provides to the university system to make, debt service on university revenue bonds. And the $9 million increase in this line from last year is primarily related to expenditure of state bonds on USM's Career and Student Success Center. The second item I want to note is this capital grants and gifts line of $34 million. As you can see, there was a significant increase in that line this year. It grew 319%. $20 million or 77% of this increase is associated with gifts raised for the engineering projects at the University of Maine. More specifically, the Furlan Engineering Education and Design Center. And I'm guessing that this line will continue to have increases in the upcoming years as we have the Harold Alfon Foundation Award and the matching gift challenge or requirement, I should say, associated with those dollars. So in the final item I want to note in this section is endowment return, net of amount used for operations, a loss this year of $26 million. What I more specifically want to note is that endowment returns are actually recorded across two different lines in the SHRECNIP. First is this endowment return used for operations line up under non-operating. And this amount will always be a positive number because it's the amount that we provide to fund operations based on the spending policy that the investment committee approves each year. And then the second line is the endowment return, net of amount used for operations, recorded here under other changes in net position. When you combine those two lines for FY22, it was a negative $20.1 million compared with a positive $35.4 million for FY21. Now moving nearly to the bottom of the SHRECNIP, we see this line change in net position and see that the system's net position increased by $26.1 million for FY22. That is down from the $112 million from the prior year, but it's always good to be positive. And this change actually carries over to the statement of net position, which we will now turn to that statement. And I'm actually going to pop ahead to slide 10 so that we can discuss net position first. So looking here at the bottom of the statement of net position or SNP, we see the total net position line and we see the variance column from showing the variance from 21 to 22. Again, we see that $26.1 million increase in net position that we just saw at the bottom of the SHRECNIP. Now, as you can see, net position is comprised of 4 categories. I'm not going to go into the description of these, but if you're interested in how they're technically described, those definitions can be found on pages 50 and 51 of the annual report. But I do want to take a moment and touch on unrestricted net position, which is basically net position that doesn't fall in any of the other 3 categories. That's basically the description. This category isn't subject to externally imposed stipulations, and it's the resources are critical for the system's financial stability, and management has designated most of the balance for very specific areas. And those areas are noted on page 11. I'm not going to turn to page 11, but at the end of the presentation, if you have any questions, we'll be glad to answer any that you have on that page. Final note about this section, as you can see, unrestricted net position did decrease by $20 million from FY21 to FY22. I'll note that nearly $18 million of this decrease is actually due to temporarily funding unrestricted or a couple of construction projects with unrestricted net position pending issuance of the university's revenue bonds, and that occurred in July. So when we issued those bonds, we restored that $18 million to unrestricted net position, and that will, if the year goes well, hopefully you'll be able to see that impact in next year's financial statements. I'll now jump back to slide 9 so that we can talk about assets, and I'll just point out that, bear with me a second, I've lost my place. Okay, so looking at current assets and looking at these two lines of cash and cash equivalents and operating investments, you can see that they increased $25 million. So the system does have good and improved liquidity, with the total of those two lines being $314 million for FY22. And just to note, those two lines account for 81% of total current assets. I do want to spend a little bit of time on total non-current assets of $975 million. That line increased just 2%, but there are some very noteworthy fluctuations in that total. First is the deposits with bond trustees that you see here, decreased almost $31 million. And that's the result of spending the balance of funds from the $43 million bond anticipation note that the system issued in May of 2021. So during the course of 22, we spent down the remainder of those funds. And I also want to point out the net OPEB asset. Well, we had an asset at June 30th, 2021. As Linda was mentioning, things changed in the plan during the year. We went from being overfunded, which is the reason why we had an asset, to being underfunded. So there's no asset, and the nearly $18 million OPEB liability that we now have, you'll see a little bit later when I discuss liabilities. Endowment investments down $25 million. This is primarily related to the negative market returns for FY22. And capital assets, as you can see, this line increased $96 million from the prior year, and this line is net of accumulated depreciation. Now, within that $96 million is $141 million of actual new investments in capital assets, primarily construction, less an increase in accumulated depreciation of $44 million, and then disposal of some assets with a book value of just under $1 million. Now, the thing I want to note about this line is the $96 million is the largest net increase in capital assets in the 5 years ended FY22. The next largest increase was $18 million that we increase that we experienced in FY21, and the 3 years prior to that experienced net decreases as depreciation outpaced new investments. Now, the FY22 investment of $141 million, that was funded with a variety of sources, including that decline in deposits with bond trustees that I mentioned a moment ago, this $31 million, as well as state of Maine capital appropriation revenue and capital grants and capital grants and gifts revenue that I mentioned in our discussion of the SHRECNIP. Also in the FY22 increase is $22 million of new leased assets that we recorded pursuant to the new accounting standard. And also that $17.7 million that I mentioned, we temporarily used from net position pending issuance of bonds in July. Moving further down the page, we see deferred outflows of resources of nearly $32 million. The fluctuation in this line is related to the OPEB plan and some of that difference in experience between projected investment returns versus what we actually experienced. And that wraps up the asset section, and I'll go back to page 10 and address liabilities. And I just want to point out the a few lines here. As you can see, accounts payable grew 94%. This is primarily related to increased construction activity leading up to June 30th. And actually within this $36 million at June 30th, 2022 is $20 million of accounts payable related to construction projects. The next variance I want to note is down under accrued liabilities, 72 million for this year, 54 for last year. For the $18 million increase, that's that net OPEB liability that we have at the end of this year compared to the $18 million asset we had the prior year. Also here, non-current portion of lease liabilities. That line is new for 21 and 22, the first time we're seeing it on the statement of net position, but we did have new leases during FY22 that we entered. And this $20 million increase is primarily related to the lease of the 300 4th Street property in Portland. And the last variances I want to note relate to long-term debt. As you can see, long-term debt is spread across a current portion. Spread across a current portion and a non-current. And as you can see, there was a shift, a big shift from non-current to current. And it's related to the bond anticipation notes. Their maturity date is, or was, July of 2022. So we classified the $43 million balance of those bond anticipation notes as current. And just finishing up this page, if we move down slightly, we see deferred inflows of resources decreased. Again, this line is, or the change in this line is primarily related to the OPEB plan. So as Linda had mentioned, that OPEB plan has a material impact on the system's financial statements. And you've seen that through today's discussion of the SHREC-NIP and also the assets and liabilities here. And so we've already discussed net positions, so I'll just move briefly to pages 12 and 13, just to point out that on page 12, we have the statements of fiduciary net position covering those assets that we hold on behalf of other parties. And on page 13, we have the statement of changes in those assets. And I don't plan to spend any time on these two pages, but we'll be happy to entertain any questions you have. And that actually concludes my remarks. And so questions, whether here or on anything else.
Well, thank you very much, Dollar. Appreciate it for that very thorough report. I have just one question going back to the revenue side. You mentioned that the revenues were increased, but they were below the pre-pandemic numbers. How far below were they before that?
If I recall, the total operating revenues for FY19 were just under $370 million. I checked my notes for the VOT meeting.
Great. Are there any questions?
Chair?
Yes, Darcy Bartholomew.
Darla, good presentation. Just quickly, operating loss restated was $344 million this year. How does that compare historically to the previous years? Just for some context.
Well, with the well, I do have a slide on or a work paper on that. Let me. So operating losses, $344 million for FY '22, $275 million for FY '21 as restated, $303 million for FY '20, and $254 million for FY '19.
Thank you.
A quick comment, Mr. Chair.
Yes.
I just wanted to note that, it's easy to get lost in some of these numbers, but I am encouraged that, a lot of things we do, on FFT and this committee and the board, you don't see the results for several years. And I always express my frustration with Gordian report. And we're just getting to the point where we're actually starting to see some of those positives. And I see some of those similarities in this. When the chancellor first came on board, one of the things that we talked about was we needed to, diversify our funding when it came to capital requests and not just rely on the state. And we've seen that in our own operating budgets. And I think you start to see some of those results in here. And as Darla said, I think we're going to continue to see those numbers grow. Our focus on educating appropriators about our needs, we see that in the appropriation line. The increase in state capital investments, we're starting to see that. The capital grants and gifts, as you noted again, are up substantially. So, it's nice to see some of that hard work actually show up and start to see some of those results. And so just wanted to acknowledge that.
Yeah, thank you very much, Ryan. Appreciate it. Any other questions for Darla?
Just a quick observation. If I look at slide 6, it's interesting. Tuition and fees are up 7.4 million year on year. Scholarship is up 8.3 million. So we actually gave out an extra million in scholarships, more than we took in incremental revenue for tuition and fees. Anybody any comments on that?
I'm looking to Ryan. I'm pretty sure he has some comments.
Yeah. One of the interesting things, because we certainly noticed that you can really see it. I mean, the best place to look at that is the campus profile document that we put out. You can see that history over a 13-year period and kind of see that trend. And there are positives in there. Again, when we recently put together a chart that showed students and the increase in scholarships and the impact that has on the number of student loans. And we see the number of student loans are going down substantially. So certainly that's a positive. But it does present some fiscal challenges. It's not quite as easy as looking at that because it varies by campus. And so, a couple $1 million increase at Orono could drown out 6 other campuses. So it's certainly something we need to look at campus by campus, but certainly notice that, especially on some of our campuses that struggle. I mean, you look at the enrollment at Farmington, but look at the increase that they continue to make in financial aid. So there are conversations we're having now, and certainly we'll continue to have as part of the 2024 budget.
Thank you, Ryan. Any other questions? If not, thank you very much, Darla. Really appreciate it.
Can I just make a further comment about the scholarships and financial aid? It is a difficult prospect. It's a difficult harvesting mechanism, because if we want to attract students, it's important to tell them very early on, or if not at the time of their acceptance, that what their package will look like. And it is a bit of a guessing game as to what percentage of students will take that package in any given year. Having said that, I think the trend of paying students to join us in competition with the likes of Husson, for instance, have put us under a lot of pressure to include those offers early and, quite frankly, more substantially. We are competing in state with an institution that has much higher costs, but makes everyone feel good about giving a substantially larger financial package than we average.
Thank you, Chancellor. President.
Thank you, Trustee Michaud. I would just add to this that this, at least for us at the University of Maine and Machias, is something we're watching very carefully. It is, as the Chancellor says, difficult to predict with certainty what the uptake will be, but I've started have this in a couple of areas, a group that is going to be meeting with me regularly, perhaps as often as every 2 weeks with updates. One of those groups is student financial aid, so that at my office level, I'm really aware of where they are, what the modeling looks like, what the trends are showing month by month. But I assure you it's of importance to us.
Great. Thank you very much, Joe. Any other questions? If not, we will, I'll read the text of the resolution that the audit committee forward this item to the October 26, 2022 Special Board of Trustees meeting for approval for the following resolution. That the Board of Trustees accept the recommendation of the Audit Committee and approves the fiscal year 2022 annual financial report as presented. There any questions? Can I have a motion?
So moved.
It's been moved by Trustee McMahon. Is there a second?
Second.
It's been seconded by Chair Riley. Ellen, will you take the roll call vote?
Certainly. Trustee Bartholomew,
Yes.
Trustee McMahon,
Yes.
Trustee Martin,
Yes.
Trustee Michaud,
Yes.
Trustee Riley.
Yes.
The motion is carried.
Great. Well, thank you very much. Appreciate it. Now moving on to tab number 5. We're a little behind schedule, so I'll turn it over to Mike and Clifton. Michael and Clifton.
Sorry, Trustee Michaud, I think you mean Michael Johns from Clifton Larson Allen.
Yes. Yep. Excuse me. Yes. Is he? I don't see him on the screen.
We can't hear you, Mike.
I don't see Michael on there.
No, Michael Johns. That's who
Okay.
she was talking.
Yes. Mike, do you want me to display your presentation for you?
You're having audio problems, Mike. We can't hear you.
Can you hear me now?
Yes, we can.
All right. Sorry about that. I never know if this headset's going to work or not. But thank you for having us, everybody. Darla, did you say you will be showing the slides, or
I can, yes. Yep.
For those of you I haven't met, my name is Mike Johns, and I am the engagement principal on the systems audit. And today we are going to end the audit process with our required communications and some other matters that we're seeing in the industry, and just the audit results, which Darla kind of spoiled a little earlier in her presentation, but good news, I don't have anything different to report. Darla, if we could skip ahead 2 slides, maybe 3. Oops. So what were we engaged to do? CLA was engaged to audit the financial statements of the system for the year ended June 30, 2022. We are required to follow our professional standards in performing that audit, and that includes generally accepted governmental auditing standards, because you do get grants from the federal government. Part of the audit process, we look at controls, we walk them through, we test them in some cases. However, during a financial statement audit, we do not express an opinion on the internal controls of the system. And that's consistent with any financial statement audit any entity would receive outside of the Sarbanes-Oxley world. And then we have required communications to this group, which we're taking care of today. Next slide, please. We're required to perform what the standards call a risk-based audit. And in a nutshell, that means we spend more time where we see more risk of error or fraud or anything going wrong occurring. and plan accordingly with our substantive procedures. So some of the highlights of that risk assessment were the internal control systems. Revenue recognition, was revenue recognized in the correct period? Does it exist? Are the liabilities presented on that statement of net position complete and accurate? We take a look at management's estimates and the inputs into those estimates to make sure we don't have any disagreements. The new lease standard, which was gone over in detail, we audited a lot of those new leases to make sure the new standards were appropriately applied. And of course, the higher education emergency relief funding, we took a hard look at the allowable costs supporting those revenue streams to make sure, again, that grant revenue was properly earned and the expenses are in the correct period. Next slide, please. So the results of that audit, as Darla mentioned, a clean opinion. We call it unmodified opinions because we have to express an opinion on each of the sets of financial statements that were reviewed earlier. We do note in our audit report that we do not audit the component unit, which is the foundation, the University of Maine Foundation. They engage separate auditors to audit those financial statements, and we reference that fact in our opinion, and that our opinion on the system as a whole, as it relates to the foundation, is based purely on the audit report of the other audit firm. There is certain what's called supplementary information in that large document that everyone has. That's the management's discussion and analysis, and some tables in the back on pension and other post-employment benefits. We do not express an opinion on that supplementary information. We review it, we agree it to the work we've done, but we do not express a separate opinion. Next slide, please. Going on to the required communications, and we can go ahead. This is what our professional audit standards say. We need to communicate this group at the end of the audit process. So diving right into the controls, if we come across any deficiencies in the internal control system as it relates to financial reporting, that is defined as a material weakness or a significant deficiency, we would have to report it to this group. We define a material weakness as either a control is not performing or does not exist that would not prevent a material error from occurring. And a significant deficiency is less in scope than a material weakness, but in our professional opinion still warrants the attention of the governing board. And then a control deficiency, which is the least severe, that's more what we call management letter comments or observations that are not required to be reported to this group. Next slide, please. We did identify some general comments on the information technology environment. They are more best practice type recommendations. And we do have a deficiency and a significant deficiency in the financial reporting controls that we will review during the executive session. Next slide, please. Continuing on with the required communications. So there were no changes in the scope of our audit. What we were engaged to do, that scope didn't change as we progressed. The financial statement disclosures are included in the scope of our auditing procedures, and we found them to be neutral, consistent, and clear. The financial statements do contain some significant estimates, and they're listed right here in that second shape. And, you know, estimates do have, because they are estimates, can change significantly in the future. And that can be based off of what's going on in the system, the general economic environment, or other factors that we're unaware of right now. So we need to point out that they can change in the future. We do audit those estimates, and we do that by looking at management's methodology and looking at any changes from the prior year, and also comparing to our own expectations based on what we see in the industry. And we did not note any issues with those estimations and or management bias in trying to get to a certain answer. So no issues in the significant estimates there. We encountered no significant difficulties in performing our audit. Management, as always, is well prepared, and the audit went smoothly. We didn't have any disagreements on auditing or accounting matters as we performed our audit. And we're not aware of management consulting with any other third-party CPAs or what's commonly referred to as opinion shopping or anything along those lines. There was one audit adjustment that was made, and this was related to the adoption of that lease standard. And there was a, that standard, when everyone presents on the surface, sounds easy. Okay, you have a lease, you record an asset, you record a liability, but there's a reason it's 50 pages long. It has a lot of nuances to it. And for one of the leases that we tested, we noted that that lease contained a purchase option, and that management was estimating that they would exercise that purchase option. So what the rules say is when that happens, the life you have to depreciate that right of use asset over is the economic useful life of the underlying asset. And management had used the lease term, which is correct in 95% of the cases. So there was around a $2.9 million decrease in accumulated amortization and amortization expense. That was the only audit adjustment that we noted. The numbers that were downloaded at the start of the audit and now appear on your draft financial statements, only that one change was made. So that speaks very highly of management and the systems they have in place. When the draft statements are approved and we've concluded our subsequent event procedures, we'll ask management to sign a representation letter that basically says that all the information they've given us is complete and accurate to the best of their knowledge. Already mentioned that other auditors audit the foundation, and it was communicated earlier that they did change their fiscal year. So you do just have a 6-month statement ended December 31st, 21. Next slide, please. And we can keep going. Other considerations, as you can tell, I'm not an IT expert and I couldn't even get my microphone to work, but this slide is about IT, and there's an act out there called Graham-Leach-Bliley, and that act in itself is pretty old. And when it was written, first applied to financial institutions. Institutions of higher education got scoped in because of the processing of the federal student loans. So an act that seemed to be applicable to financial institutions in protecting consumer data also applies to higher education and protecting student data. And the law in itself, changes over time, and the Department of Education just asked independent auditors a few years ago to start looking at some provisions, which we cover in the federal single audit. However, this December, early December, they're requiring some changes in the act and more security measures and safeguards to be put in place, such as annual penetration testing and some more robust written documentation. We did discuss these changes with your IT personnel who are aware of it, and we're just pointing it out to this group because it is significant. Everyone reads the news. There's a lot of bad actors out there, unfortunately, and this law and being in compliance with this law helps secure that electronic data of our students. So I promised I wouldn't read the slide, and I won't. We'll go on to the next slide. Things we're hearing as we travel around or take these virtual meetings in the higher education world that governing boards or management seem to be talking about. One is the relatively new forgiveness of student loan initiative and some negative press about that. And, institutions are thinking through it. Will this cause an artificial drop in our default rates? Meaning we're forgiving these loans, would those default rates have been higher? And just what are the consequences going forward in attracting and packaging aid for students? Those higher education emergency relief funds that were a great revenue source over the past 3 years are going away. So what we're hearing is, what does the budget look like? What do the future projections look like in a life after those federal stimulus dollars are no longer impacting our non-operating revenue? So we're hearing a lot about that, and people just looking at life after these stimulus funds. Not so much applicable to large public institutions, but using our crystal ball, some of the mid-sized to smaller private schools are really struggling financially. We expect a lot of merger and acquisition, or frankly, institutions just closing down. Looking into the future, we believe that HERF was almost a Band-Aid to get them through these times, and with the enrollment cliff coming up, we expect to see a lot of that going on, which is unfortunate, but can cause opportunities for other institutions in terms of M&A activity. Changes in delivery, you know, we're supposedly post-pandemic now. What do students want? Do they want that on-campus experience? Do they want that remote learning experience? Do they want some type of hybrid? So we're hearing a lot about folks really just touching base with their students and seeing what they want and seeing if they need to invest in any further delivery of education. And the last but certainly not least, I don't know where everyone went, but after the pandemic, a lot of folks are struggling to hire competent financial personnel. And I'm sure it goes on beyond financial personnel, but that's what I hear being an accountant. And, you know, we have a lot of clients and talking at industries that are just really, really struggling to even get a competent controller on board. So we're hearing a lot of planning in that regard, looking at retirements and early recruiting and making sure that legacy information doesn't walk out the door in that respect. Next slide, please. So the next steps, we will issue the audit. We'll need that representation letter signed. We have to update our subsequent events through the date of the approval. And we do need a few legal confirmations. That's not unusual. They have to be dated within 2 weeks of our audit report date. So we send letters out to your attorneys, just making sure there's nothing out there we're not aware of that could cause potential liability to the system. Then we have the federal single audit. That's the audit of certain major federal awards that has already started and will continue through the winter and is due March 31st of 2023 for the current year end. So thank you so much for listening to an audit presentation. I didn't see anyone nodding off and would love to answer any questions anyone would have.
Thank you very much, Mike. Appreciate it. Are there any questions? Seeing none, once again, I want to thank you very much, Mike, for that presentation.
Thank you.
Okay, moving on to executive session. Could I have a motion for the Board of Trustees Committee meeting to go into executive session under the provisions of 1 MRSA Section 4056-A to discuss the evaluation of personnel and the consideration and discussion of appointments, employment, and duties, and 1 MRSA Section 4056-C to discuss the conditions, acquisitions, or dispositions or real property or economic development if premature disclosure of information would justice the competitiveness and bargaining position of the University of Maine system. Is there a motion?
So moved.
It's been moved by Trustee McMahon. Is there a second?
Second.
There's been second by Trustee Riley. Ellen, will you take the roll?
Certainly. Trustee Bartholomew,
Yes.
Trustee McMahon,
Yes.
Trustee Martin,
Yes.
Trustee Mishu,
Yes.
Trustee Riley.
Yes.
The motion is carried.
Thank you. We'll move to executive session.